Are we on the verge of another stock market meltdown? Is it really different this time? Well, let's talk about that for a few minutes. The stock market is at an all-time high, okay? It's definitely not factoring in, a recession or even a slowdown. It's for sure pricing in a soft landing, that the Fed, which they have failed out of the last 6 times, 5 times the Fed failed to manage a soft landing. It has 100% bought its hook, line, and sinker. And the market is the market. Market's going to do what it's going to do. One thing with the market is the market's always 6 months ahead of economic data or macroeconomic conditions. So we're at an all-time high. Fed and global central banks are cutting rates, like I discussed in the previous segment. While lower interest rates are good for the stock market, are we going to have a melt-up going forward from here? What do you guys think? I don't think so. I think so when the market prices things in, there's a saying, I'm sure many of you have heard me say that, market goes up the stairs and it takes the express elevator down, like it happened with the Japan carry trade situation about a month ago. Nasdaq sold off 15% in 2 weeks. I mean, that's a lot. And if you guys were in the market, you guys knew how vicious that was. But then it came right back. So that means market's still looking at soft landing. Market's not looking at economy slowing down. But so if it's not going to slow down, if everything is fine, and now the Fed and the global central banks are cutting rates. Look, China cut the rates, and what happened? I mean, their stock market went up, literally up 25%. This is the whole market we're talking about. Individual stocks did a lot more. So, okay, well, are we going to have a melt up? I don't know. I don't think so. I think this is just suckering in pretty much everybody that needs to get in, because the market is a mechanism to make everybody wrong. Again, am I trading? Of course. Am I going short the market? Of course not. I won't do any of that until I see the picture. But then I'm ready for it. I have my tools ready. I have my gun loaded. My account is 85% cash these days. And, I'm trading with 15%. I'm trying to protect equity, right? And I'm trading my equity. I'm not even looking at individual positions when I get in and out. But when the time comes, I definitely am ready for a little swoosh. But so the S&P 500, okay, if you guys, by the way, had taken any advice from me, and dollar cost averaged over the past, God knows how many months, you should be doing great. But if you did it over the past few years, or 10 years, or 15 years, or 20, that's why there is no bad time to invest. Just open a small account, $50 a month, $100 a month, whatever you can put in there. By the way, the statistic is this: if you're 25 years old and put just $100 a month, one single $100 a month, not day, not week, into an index fund such as S&P 500 or the triple Qs, whatever you choose, okay? By the time you retire, this is not a joke. You guys can go Google this. By the time you retire, not even by the time you retire, by the time you're 55, 10 years before the retirement age, with compounding, and basically every first of the month, your dollar cost averaging into an index fund, okay? You would have $1.2 million. Would you not want to have that? This is outside your earnings on your, W-2. This is outside your 401k. This is outside your retirement IRA. This is outside all of that, right? Just $100 a month. And at the age of 65, which is when hopefully you're going to collect retirement, right, from the government, which I don't think you will if you're young, but I'm hoping in 8 years, I'm hoping Social Security is there, that I get some of my money back, is you would have over $2 million. You guys are going to go, that's silly, Serge. It's not possible. I'll go Google it, and then you guys will understand that it is possible. But so start investing. There is no bad time to start investing. And S&P 500 rallied 20.8% in the first 3 quarters of 2024. 21% almost in just 3 quarters, posting its biggest gain since 1997. Is every year going to be like this? Of course not. What is the average? Is about 9-10%. Reinvesting the dividends is about 10.5%, right? This goes back, by the way, includes all the crashes, all the bad things that you guys hear about because the media makes a big deal out of it. The point I'm trying to make is, on average, it's about 10%. I take 10%, and then you guys have to understand the rule of 72. 72 divided by 10 is 7.2 years. Every 7.2 years, your money is going to double. Think about it. If you're earning 10% return on something, this is nearly double, right? The average 11.7% increase seen last year, and the third best performance since 1990. So market is definitely pricing some rosy pictures in here. And the global central banks are saying, well, maybe it's not that good because we need to cut rates. So there is something is going to give here. We're either going to have a melt up or we're going to have a meltdown, one or the other, because lower interest rates are supposed to be good for stocks, right? The index also recorded the best start to a presidential election year in history, which we have in 30 days coming up. I can't wait until that thing is over. Last week, the S&P 500 hit its 43rd all-time high this year, the best streak since 70 new records in 2021. And 2021 was what? We were pumping money like crazy, $7-8 trillion. Economy was like taking off, coming out of the pandemic, right? Everybody was getting their vax. And I'm like, yeah. So since October 2023 low, and when the Fed started, by the way, increasing rates, abandoned the ZERP policy and went from 0 to 5%, the market sold off about 30%, by the way, people. So that wasn't a joke, right? That was between late 2022 all the way to October 2023. The index is up a massive 40%. So that's from the low, but you don't have to cash the low. Just dollar cost average, $100 a month into the same index fund, or take two index funds and put half in there and half in there, and just, it's like set it and forget it. Okay, that's as simple as I can put it to you guys. This market feels unstoppable. Well, we'll find out. Kobesi letter. I don't agree with this. It's that but it says feels unstoppable. That I agree with. It's unstoppable. So, and of course, there is always a chart with them. S&P 500 year-to-date price change through the end of Q3. This chart goes back to 1990. Okay, so 1990 obviously is, what, 34 years or 30, something like that. So you guys see mostly it's up bars, green bars, right? So this is every single year what the market has done, the return on the S&P 500. Very few, but then the few that are red, that means down on the market, are pretty massive, right? Okay, so in 2000, 2002, that period, what was that period? Dot-com bust, right? The bubble burst. First year, market down 2.2%, S&P 500. The second year, down 21.2%. Third year, down 29%. So if you add all those three up, we're talking over 50% decline in the market. So when the market declines by 50%, guarantee you your stock is going to decline by 80%, okay? And then what happens though? See, this is the power of dollar cost averaging. So when the market's tanking, you're buying at a lower price. When the market's going up, you're buying at a higher price. That's why it's called dollar cost averaging. You don't care what the market is doing. You just pop in $100 a month and, look at a pretty picture going forward. Because $100 a month, by the way, could be saved so easily. So easily. How? I don't want you guys to change your lifestyle, because $100 a month today, in today's dollars, is nothing. Okay? Because you go to McDonald's now, family of four, eat, it's $100. Okay. I'm not saying for you not to do that, but we all have these individual little perks for ourselves, right? I'm pretty sure most of you, or all of you, go get $5.50 to $7 cup of Starbucks, pretty much at least 3 to 5 times a week, if not every day. How about we just prep that at home? And I'm not saying don't splurge. Maybe do it once a week. Just cut that part. That will be your $100 a month. Period. Simple, right? Those are the pleasures of life. I understand. I'm not telling you guys to stop doing that stuff. Okay? So the point is, just cut down on stuff that when you're about to buy something, you go, do I really need this? Right? And think about your 1.2 million in 30 years and go like, no, I don't think I need it. And let's just take that $10, take that $5, that take $8. or the change or whatever that you're about to spend on something that you really don't need, or the plastic that you're going to use to buy something on Amazon that you don't need, just go, no, I think it's going to go into my fund. And you just take that, and then the first of the month, plop, $100 in. Again, $50, $20, whatever you can do, but start doing it. And don't come and tell me, oh, I'm too old, I don't think it's going to work. I'm like, why is it not going to work? Okay, let's say you're 50 years old. You start doing it. By the time you're 70, you will have $600,000. I mean, I don't know. I think it's pretty good money. Although in 20 years, your $500,000 might not buy much because of inflation. But hey, would you rather not have it? Yeah. Okay. So then, obviously, market turned around in 08. We know what happened. S&P 500 down 20%. And then the big one, of course, during the pandemic, S&P 500 down 25%. But most of the time, the average returns are up, and more green bars than red. So, however, we're at an all-time high when the Fed is cutting rates. So either a melt up or a meltdown is coming, and I'm ready for both. I'm going to end this with the Kobesi letter's wonderful summary. Okay, stocks are rising like we have avoided a recession. Agree. Gold prices are rising like we're heading into a recession. Agree. Gold is making all-time new highs. What is gold? Gold is an inflation hedge. Now, if the Fed and the global central banks are cutting rates, is this going to accelerate inflation back up again? That's what gold is saying. Oil prices are rising like we're heading towards World War III. Agree. I mean, we know what's going on in the Middle East, right? So what happens if Israel goes and decides to blow up all the oil infrastructure of Iran? By the way, Mr. Waltz, it's not Iran, it's Iran. Okay, I mean, you're an educated man, and but they all do it in Washington. They go Iraq and Iran. You're not running anywhere. It's Iran. So number 4, bond prices are falling like geopolitical tensions are easing. Very true. Like today, bond prices actually fell because interest rate jacked up because unemployment numbers came out a lot stronger, according to the government, than expected. Crypto is falling. Crypto, I thought it was decoupling itself, but it doesn't seem like it. It seems like it's just following the market. It went up to 65. Now we're back down to 62. But then I'm telling you guys, I'm going to do a wonderful interview about crypto with a gentleman who did something that I think is brilliant. But you guys have to stay tuned for that. Crypto basically has been going between, when I say crypto, I only have one crypto in mind, which is Bitcoin. It's been going between 58 and 68 for 6+ months now. So if I'm a trader and I'm looking at that chart, that thing has been going sideways for so long. Either that's a massive top that the bottom is going to fall off, or that's just a consolidation phase that when we take off, we're doubling. So we will talk about that, how to take advantage of that as well, coming up shortly. And tech stocks are rising like risk appetite is at all-time highs. Absolutely. Look at the Mag 7. Look at the NASDAQ, right? So here it is. Finally, Kobesi letter says the epitome of a broken market. So many variable signs, and we'll see. We'll see. We'll see what happens. But on this topic, my conclusion is: are we going to have a melt up? No. Are we going to have a meltdown? Okay. Are we going to have a meltdown more likely than we're going to have a melt up in the stock market? So